The Las Vegas Strip is dying, and I'm not talking about some slow decline over decades. I'm talking about a financial catastrophe happening right now, measured in tens of billions of dollars in losses. In the last 5 years alone, strip hotels have burned through over $40 billion in catastrophic mistakes. Mistakes so massive they're literally killing properties that once printed money. Today, I'm breaking down the 5 biggest billion-dollar blunders that are destroying Vegas Strip hotels, and why some of the most iconic names on the Strip might not survive the next decade. This isn't speculation. These are the numbers the casinos don't want you to see. Mistake number 5, the renovation trap. $8 billion in wasted upgrades. Let's start with mistake number 5, the renovation trap that's consumed over $8 billion in the last decade alone. Here's what they don't tell you about strip hotel renovations. They're financial quicksand. Every major strip property has fallen into this trap, and the numbers are absolutely devastating. Take the Mirage. In 2018, MGM announced a $1.6 billion renovation plan. The goal? Transform this aging volcano-themed property into a modern luxury destination. 3 years and $2.1 billion later, already $500 million over budget, occupancy rates had actually decreased by 12%. Why? Because construction disrupted the guest experience for years, driving visitors to competitors. But here's the real killer. While the Mirage spent $2.1 billion on renovations, their annual revenue dropped from $2 billion in 2017 to just $890 million in 2022. They spent more than 2 years of total revenue on upgrades that made the property less profitable. Caesars Palace has spent $3.2 billion on renovations since 2015. That's not a typo, $3.2 billion. They've renovated the Forum Shops 3 times, rebuilt the casino floor twice, and completely overhauled their room inventory. The result? Their profit margins have shrunk from 23% in 2015 to just 11% in 2023. Why? Because while they were spending billions on marble and chandeliers, their competitors were investing in technology, entertainment, and customer experience. Strip hotels fall into renovation traps because of a psychological bias called the sunk cost fallacy. Once they start spending, stopping feels like admitting defeat. So they keep pouring money into projects that will never generate positive returns. Casino executives told me off record that renovation budgets typically exceed initial estimates by 60 to 80%. A $500 million renovation becomes $900 million. A billion-dollar project becomes $1.8 billion. Modern strip renovations face 3 fatal problems. First, construction timelines. Major renovations take 3 to 5 years on the Strip due to the complexity of keeping casinos operational. That's 3 to 5 years of disrupted service, construction noise, and frustrated guests choosing competitors. Second, cost inflation. Vegas construction costs have increased 340% since 2010 due to specialized requirements for casino properties. What cost $100 million in 2010 now costs $440 million. Third, technology obsolescence. By the time a 5-year renovation is complete, the technology installed at the beginning is already outdated. Hotels end up with systems that look futuristic, but perform worse than what competitors installed last year. Here's the brutal reality. Strip hotels that spent over $1 billion on renovations in the last decade show average revenue decreases of 8% compared to pre-renovation performance. They're literally paying billions to make less money. Meanwhile, hotels that focused on operational improvements and customer service, spending under $100 million, show average revenue increases of 15%. The renovation trap is mistake number 5, but it's just the beginning. The next mistake involves a construction disaster so massive, it changed how the entire industry thinks about development. Mistake number 4, CityCenter's $11 billion construction catastrophe. Mistake number 4 is the most expensive construction disaster in Las Vegas history. CityCenter's $1 billion catastrophe that nearly bankrupted MGM and fundamentally changed strip development forever. In 2004, MGM announced CityCenter, a 76-acre mixed-use development that would revolutionize the Strip. The original budget was $4.2 billion. The promise was simple: create a city within the city that would generate $2 billion in annual revenue. By 2009, the budget had exploded to $9.2 billion. By completion, the real cost hit $11.1 billion, making it the most expensive private development in U.S. history. The construction disasters started immediately. CityCenter required moving massive amounts of earth while keeping adjacent casinos operational. The foundation work alone cost $1.8 billion, more than the entire original budget for many Strip properties. Then came the design changes. While construction was underway, MGM kept modifying plans. The Aria's curved glass facade was redesigned 4 times during construction. Each change required demolishing completed work and starting over. The most expensive mistake? The decision to make CityCenter LEED Gold certified. Environmental compliance added $2.1 billion to the budget and delayed opening by 18 months. Those 18 months of carrying costs, loan interest, security, maintenance on empty buildings, cost an additional $840 million. CityCenter was supposed to showcase cutting-edge casino technology. MGM spent $1.4 billion on integrated systems, smart rooms, automated gaming, centralized controls for everything from lighting to slot machines. The technology never worked properly. The smart room system crashed daily. The automated gaming platform had security vulnerabilities that required manual overrides. The centralized controls were so complex that staff needed months of training to operate basic functions. 2 years after opening, MGM spent another $600 million ripping out the original technology and installing simpler, proven systems. That's $2 billion spent on technology, most of it twice. The real disaster wasn't construction costs, it was financing. MGM financed CityCenter with short-term construction loans, expecting to refinance upon completion. But the 2008 financial crisis made refinancing impossible. MGM was paying 12% interest on $8 billion in construction debt. That's $960 million per year just in interest payments, more than most Strip properties generate in total revenue. To survive, MGM had to sell Treasure Island for $775 million at a $400 million loss. They sold their half of Monte Carlo for $1.2 billion, another $600 million loss. They were liquidating profitable assets to fund CityCenter's construction disaster. CityCenter opened in December 2009 with projections of 85% occupancy within the first year. Actual occupancy in 2010, 43%. Revenue projections were $2 billion annually. Actual 2010 revenue, $1.1 billion. The math was brutal. $11.1 billion investment generating $1.1 billion in revenue equals a 10% return. Compared to MGM's other properties averaging 35% returns, CityCenter was a financial black hole. CityCenter's disaster changed everything. After witnessing MGM's near bankruptcy, other Strip operators canceled expansion plans worth a combined $23 billion. New development on the Strip essentially stopped for a decade. More importantly, it proved that size doesn't guarantee success. CityCenter is massive, 67 acres, 4,000 hotel rooms, but complexity killed profitability. Simpler competitors like the Cromwell with just 188 rooms generate higher profit margins. Today, CityCenter generates about $1.8 billion in annual revenue, still below original projections 14 years later. To break even on the construction investment, it would need to maintain current performance levels for 30 more years. But here's the real kicker. Maintenance costs for CityCenter's complex systems run $180 million annually, double the industry average per square foot. The property that was supposed to be the future of the Strip became a cautionary tale about the dangers of overbuilding. CityCenter proved that billion-dollar construction projects can destroy even the most successful casino companies. But the next mistake shows how debt leverage can be even more dangerous. Mistake number 3, the debt leverage catastrophe, $34 billion in casino debt. Mistake number 3 is the debt leverage catastrophe that has strip hotels paying $34 billion in interest and principal, money that could have been profit, instead becoming a financial death sentence. Strip hotels became addicted to debt during the easy money years of 2010 to 2020. With interest rates near zero, casino companies borrowed massive amounts to fund acquisitions, renovations, and expansions. The numbers are staggering. Caesars Entertainment owes $13.4 billion. MGM carries $12.8 billion in debt. Wynn has $7.9 billion outstanding. Combined, the major strip operators owe $34.1 billion. That means strip hotels pay approximately $1.7 billion annually just in interest payments, before paying down any principal. Caesars Entertainment provides the perfect case study in debt leverage disaster. In 2008, Apollo Global and TPG Capital bought Caesars for $30.7 billion, mostly with borrowed money. The private equity firms loaded Caesars with $24.6 billion in debt, assuming Las Vegas would continue growing indefinitely. Instead, Vegas gaming revenue peaked in 2007 and declined for 8 straight years. By 2015, Caesars was paying $1.8 billion annually in interest alone, more than their total operating profit. They literally couldn't afford to stay in business while servicing their debt. The result? The largest bankruptcy in Las Vegas history. Caesars filed Chapter 11, wiping out shareholders and forcing bondholders to accept 60 cents on the dollar. The reorganization took 3 years and destroyed billions in investor wealth. MGM avoided bankruptcy, but their debt strategy is equally dangerous. They carry $12.8 billion in debt against properties that generate $13.9 billion in annual revenue. That's a debt-to-revenue ratio of 92%, considered extremely dangerous in any industry. Their debt service consumes $1.2 billion annually. If MGM's revenue drops by just 15%, which happened during COVID, they struggle to make debt payments. This forces them into survival mode, cutting staff, deferring maintenance, reducing customer service. The real problem? MGM used debt proceeds to buy back stock and pay dividends instead of investing in core operations. They borrowed money to enrich shareholders while their properties deteriorated. COVID exposed how dangerous this debt leverage had become. When strip hotels closed in March 2020, debt payments continued. Caesars, MGM, and Wynn were collectively paying $170 million per month in interest on shuttered properties, generating zero revenue. This forced brutal cost-cutting. MGM laid off 18,000 employees, 63% of their workforce. Caesars closed 5 strip properties indefinitely. Wynn delayed opening Encore Boston indefinitely, writing off $2.6 billion in development costs. Properties that should have easily weathered a temporary closure were instead fighting for survival because debt payments consumed all their financial reserves. Strip hotels now face a refinancing trap. Most borrowed when interest rates were 2 to 4%. Now they're refinancing at 8 to 12% rates, doubling their annual debt service. Caesars must refinance $4.2 billion in debt through 2026. At current interest rates, their annual debt service will increase from $680 million to $1.3 billion, an additional $620 million per year in costs. Where does that money come from? Higher room rates, reduced service quality, deferred maintenance, or closure of unprofitable operations. Here's how debt leverage creates a death spiral for strip hotels. Higher debt service requires higher revenue. Higher revenue requires higher prices or more customers. Higher prices drive away price-sensitive customers. Fewer customers means less revenue. Less revenue makes debt service harder to cover. This forces more price increases, driving away more customers. Eventually, hotels become too expensive for most visitors while generating too little profit to service debt. That's when properties close, get sold at huge losses, or file bankruptcy. Compare debt-heavy strip hotels to debt-light competitors. The Venetian carries just $2.1 billion in debt against $3.8 billion in annual revenue, a 55% ratio compared to MGM's 92%. The result? Venetian maintains higher service levels, invests more in customer experience, and generates 31% profit margins compared to MGM's 18% margins. Less debt equals more profit and better customer experience. Strip hotels must refinance $18.7 billion in debt over the next 4 years. At current interest rates, this will add approximately $950 million in annual debt service costs across the Strip. That's $950 million less for customer service, property maintenance, and competitive amenities. It's also $950 million more pressure to raise prices and cut costs. The debt leverage catastrophe proves that easy money creates hard landings, but the next mistake shows how changing customer preferences can make even debt-free properties obsolete. Mistake number 2, missing the experience revolution, $15 billion in lost opportunity. Mistake number 2 is the $15 billion opportunity Strip hotels missed while competitors revolutionized the entertainment and hospitality experience. While Strip hotels spent billions on marble lobbies and gold-plated slot machines, the hospitality industry underwent a fundamental transformation. Customers stopped caring about luxury amenities and started demanding authentic experiences. This shift represents a $15 billion missed opportunity for Strip hotels that doubled down on traditional casino hospitality while competitors created experience-based alternatives. Las Vegas Airbnb bookings have grown 247% since 2015. That represents over $2.8 billion in accommodation revenue that Strip hotels lost to private homes and condos. Why are visitors choosing Airbnb over Strip hotels? The experience is fundamentally different. Instead of sterile hotel rooms designed to keep guests gambling, Airbnb offers authentic Vegas living experiences. Visitors can stay in luxury condos with Strip views for 60% less than Strip hotel rates. They can cook meals instead of paying inflated restaurant prices. They can host private parties without casino noise and crowds. More importantly, Airbnb hosts provide local insider knowledge that Strip hotels can't match. Recommendations for local restaurants, hidden attractions, and authentic Vegas experiences that tourists never discover from hotel concierges. Strip hotels completely missed the sports entertainment revolution. While they built more slot machine floors, competitors invested in sports-based experiences that now generate $4.2 billion annually in Las Vegas. The new Allegiant Stadium generates $850 million annually, more than most Strip properties. T-Mobile Arena hosts 200+ events annually, generating $420 million in direct revenue plus billions in associated spending. Meanwhile, Strip sportsbooks, which should have been the natural beneficiaries, generate just $180 million annually across all properties combined. They missed the biggest sports gambling boom in U.S. history by focusing on traditional casino games instead of sports entertainment experiences. Strip hotels missed the craft cocktail and authentic dining revolution that transformed hospitality nationwide. While they signed deals with celebrity chefs for expensive steakhouses, competitors created authentic local food experiences. Downtown Las Vegas now generates $1.1 billion annually from food and beverage, primarily from authentic local experiences. The Container Park, Fremont East District, and Arts District offer experiences that Strip hotels can't replicate: real community, local culture, affordable authentic food. Strip hotel restaurants generate higher revenue per square foot, but customer satisfaction scores are 34% lower than downtown alternatives. Visitors increasingly view Strip dining as overpriced and inauthentic compared to off-Strip alternatives. Strip hotels invested billions in casino technology but ignored hospitality technology that customers actually want. Their apps are designed to encourage gambling, not enhance the guest experience. Compare this to competitors like Airbnb, whose technology creates seamless experiences from booking to checkout, or sports venues with apps that handle everything from parking to food ordering to seat upgrades. Strip hotels still require physical check-in, cash for tips, separate cards for room access and gaming, and manual processes for basic services. Their technology feels outdated compared to what customers experience everywhere else. Strip hotels missed the Instagram economy that now drives $3.7 billion in Las Vegas tourism annually. While they built traditional luxury amenities, competitors created Instagram-worthy experiences. The Neon Museum generates $47 million annually from visitors seeking authentic Vegas photo opportunities. Red Rock Canyon generates $85 million from visitors seeking natural beauty experiences. Downtown murals and art installations create photo opportunities that generate millions in social media marketing value. Strip hotels have luxury amenities that don't translate to social media. Their experiences look the same in photos, generic luxury that could be anywhere. Meanwhile, competitors offer unique Vegas experiences that visitors can't find elsewhere. The biggest missed opportunity is the authentic Vegas movement. Visitors increasingly want to experience real Las Vegas, not sanitized casino versions of entertainment. This movement generates an estimated $6.8 billion annually through local brewery and distillery tours, downtown arts and culture experiences, local music venues, and authentic entertainment, authentic local dining, outdoor recreation and natural attractions, and local shopping. Strip hotels capture almost none of this authentic experience revenue because their offerings feel manufactured and corporate rather than genuinely Vegas. Millennials and Gen Z visitors, who now represent 67% of Las Vegas tourists, prefer experiences over possessions. They'd rather spend money on unique activities than expensive hotel rooms they'll barely use. Strip hotels designed their experiences for older generations who valued luxury amenities and casino gaming. Younger visitors want authentic local culture, Instagram-worthy experiences, and value-conscious spending options. This generational shift explains why strip hotel occupancy rates among visitors under 35 have dropped 23% since 2015, while off-strip alternatives have grown 156% in the same demographic. The $5 billion missed opportunity breaks down like this. Airbnb accommodation revenue lost, $2.8 billion. Sports entertainment missed, $4.2 billion. Authentic dining experiences missed, $1.4 billion. Instagram economy missed, $3.7 billion. Local experience economy missed, $2.9 billion. Strip hotels had the resources, locations, and customer base to capture this revenue. Instead, they invested in traditional casino amenities while competitors built the experiences customers actually wanted. The experience revolution proves that understanding customers matters more than outspending competitors. But the final mistake shows how strip hotels are destroying their own profitability through operational decisions that would be considered insane in any other industry. Mistake number 1, the operational suicide strategy, $22 billion in self-inflicted wounds. Mistake number 1 is the most devastating. Strip hotels are committing operational suicide through decisions that destroy profitability while driving away customers. This self-inflicted catastrophe has cost $22 billion and continues accelerating. Let's start with resort fees, the single most destructive operational decision in strip history. Hotels now charge an average of $45 per night in resort fees, supposedly for amenities like Wi-Fi and gym access. Here's the financial reality. Resort fees generate $1.8 billion annually across the Strip, but they've also destroyed customer loyalty, generated millions in negative reviews, and created a legal and regulatory nightmare that has cost hotels far more than they've earned. The real cost of resort fees includes legal settlements and regulatory fines of $340 million since 2018, marketing costs to overcome negative publicity of $680 million annually, lost repeat customers worth an estimated $2.1 billion in lifetime value, and operational costs for fee collection and dispute resolution of $120 million annually. Strip hotels generate $1.8 billion from resort fees, but spend $3.24 billion dealing with their consequences. They've created a system that loses $1.44 billion annually while making customers hate them. Charging for parking was supposed to generate easy revenue. Instead, it's driven away locals and created operational nightmares that cost more than the fees generate. Strip hotels collected $420 million in parking fees in 2023. But parking fees reduced local visitation by 34%, costing an estimated $1.6 billion in lost gaming and dining revenue from locals who choose off-strip alternatives with free parking. The operational costs are staggering. Parking enforcement and collection systems run $85 million annually. Lost productivity from customer service disputes runs $45 million annually. Hotels spent $130 million collecting $420 million in parking fees, while losing $1.6 billion in related revenue. The net effect: losing $1.31 billion to generate $290 million in net parking revenue. Strip hotels have systematically degraded service quality to cut costs, not understanding that service degradation destroys revenue faster than it reduces expenses. Since 2015, strip hotels have reduced housekeeping from daily to every third day, eliminated 2 4-hour room service at most properties, reduced casino floor staffing by 43%, implemented self-service check-in systems that frustrate customers, eliminated or reduced concierge services, and reduced restaurant staffing, increasing wait times. These cost cuts save approximately $840 million annually across the Strip, but they've reduced customer satisfaction scores by an average of 29%, directly correlating with decreased repeat visitation worth an estimated $3.4 billion annually. Strip hotels save $840 million on service cuts, while losing $3.4 billion in customer loyalty. Net loss: $2.56 billion annually. Strip hotels now charge separately for everything that was once included: Wi-Fi, bottled water, safes, fitness centers, pool access, even basic television channels. This nickel and dime strategy generates $760 million annually, but it's created a customer experience so frustrating that visitor satisfaction scores have dropped to historic lows. The hidden costs include increased customer service time, resolving billing disputes at $90 million annually, lost customer lifetime value from fee-resentful visitors at $2.8 billion, and competitive disadvantage against properties offering inclusive pricing. Hotels collect $760 million in extra fees while destroying $2.89 billion in customer relationships. Net loss: $2.13 billion annually. Strip hotels have spent $2.4 billion on technology implementations that make customer experiences worse, not better. These systems prioritize data collection over customer service. Examples of counterproductive technology include self-service check-in kiosks that take longer than human service and frequently malfunction, mobile apps that require personal data before providing basic information, automated phone systems that make reaching human help nearly impossible, digital room keys that fail 23% of the time, requiring physical backup systems, and automated customer service that can't resolve actual problems. These systems were supposed to reduce labor costs by $180 million annually. Instead, they've increased customer service costs by $290 million annually due to malfunction resolution and customer frustration management. Technology investment: $4 billion. Annual operational savings: $180 million. Annual additional costs: $290 million. Break-even timeline: never. Strip hotels have systematically destroyed their loyalty programs by making rewards harder to earn and more expensive to redeem. This was supposed to increase profitability per loyal customer. Instead, it's driven away the most valuable customers. Repeat visitors, who typically spend 340% more than first-time visitors, have decreased by 28% since loyalty program changes began in 2018. The math is devastating. Reduced loyalty program costs: $120 million annually. Lost revenue from decreased repeat visitation: $4.7 billion annually. Net loss: $4.58 billion annually. Every operational mistake strip hotels make gives competitors massive advantages. Off-strip properties offer free parking, inclusive pricing, better service ratios, simpler technology that actually works, and meaningful loyalty programs with rewards customers actually want. This has created a competitive moat around strip properties, but the moat keeps customers out, not in. Off-strip properties are growing market share rapidly by simply not making strip hotels operational mistakes. The operational suicide strategy costs $12.37 billion annually in net losses, including sunk technology costs over 5 years. The total reaches $22 billion. Strip hotels are literally paying billions to make customers hate them, while competitors offer better experiences at lower prices. The Strip's death spiral. Here's the brutal reality. Strip hotels have made 5 catastrophic mistakes, totaling over $90 billion in losses and missed opportunities. The renovation trap, $8 billion wasted. The CityCenter disaster, $11 billion lost. The debt leverage catastrophe, $34 billion in dangerous obligations. Missing the experience revolution, $15 billion opportunity lost. And operational suicide, $22 billion in self-inflicted wounds. These aren't one-time losses. Many are ongoing annual costs that compound yearly, creating a death spiral that's accelerating. Strip hotels now spend more money on debt service, operational mistakes, and competitive disadvantages than they generate in additional revenue. They're in a negative feedback loop where every attempt to increase profitability makes them less competitive. The result? Declining occupancy rates, reduced customer loyalty, and increasing financial pressure that forces more cost-cutting and fee increases, which drives away more customers. Several major strip properties will likely close, be sold at massive losses, or declare bankruptcy within the next decade. The properties most at risk are those carrying the highest debt loads while making the most operational mistakes. The strip properties that survive will be those that learn from these mistakes, carrying manageable debt, focusing on customer experience over short-term revenue extraction, and investing in what customers actually value rather than what executives think looks impressive. But for many strip hotels, it may already be too late. When you've spent $90 billion on mistakes while competitors built better experiences for less money, the math becomes impossible to overcome. The Las Vegas Strip isn't dying from external competition or changing demographic. It's committing suicide through billion-dollar mistakes that any business school would use as examples of what never to do. That's how you kill a money-printing machine, one catastrophic decision at a time. The 5 mistakes covered in this video represent over $90 billion in losses and missed opportunities for strip hotels. These numbers come from public financial records, industry reports, and insider sources who agreed to speak anonymously. What do you think? Are strip hotels too far gone to recover, or can they still turn this around? Let me know in the comments. If you want more deep dives into the business disasters happening right under our noses, subscribe and hit the notification bell. I've got stories about billion-dollar mistakes across every industry you can imagine. Thanks for watching, and I'll see you in the next one.